Hello there, welcome to myfinanceteacher.org. Today we're going to have a market overview, so we're going to have a look at a range of different markets. In the meantime, seriously, you got to join myfinanceteacher.org. Check out this category, Juniors in Metals, where we discuss some of the juniors that will propel your portfolio higher once the sentiment in gold equities catches up with the performance of gold itself. Recently we had the most interesting update on newfound gold. You won't find anything as detailed anywhere on the internet. That's again at myfinanceteacher.org. Let's jump into the range of markets, starting with the general stock market. This is S&P 500. And the last time we looked at S&P 500 was near the end of February, where we did expect a decline down into the intermediate cycle low. Over here on the 24th of February, we mentioned that the new intermediate cycle, which started in the middle of January, wasn't really performing well, and there was a chance that the intermediate cycle had topped a little bit too early, suggesting the decline for most of the remainder of the intermediate cycle. And yes, I have to admit the decline has been more precipitous than I expected. We dropped quite a lot over here in the last few days, but even with this significant decline, the intermediate cycle so far has only been going on for 85 days, while the average duration for these intermediate cycles in the general stock market is about half a year. And yes, sometimes these intermediate cycles might be somewhat short, much shorter than half a year, but I don't expect the intermediate cycle to finish within 84-85 days. So we probably haven't really reached the end of this intermediate cycle. We haven't reached the intermediate cycle low. We are quite oversold, so there might be a bit of a short-term bounce relatively soon, most likely followed by another decline, maybe a bit of a positive divergence on RSI, that is a lower low on price versus a higher low on RSI. A positive divergence often precedes a bit of a bounce, perhaps into a new intermediate cycle rally. That's what we would expect from the perspective of the cycles. And looking at the technicals, if you switch to the weekly view, we see that this 200-week moving average isn't extremely far from where the price is right now. So if the decline into the intermediate cycle low continues, and yes, maybe after a bit of a bounce into a new daily cycle, so if we bounce into a new daily cycle, continue down into the intermediate cycle for a bit of a positive divergence, we might actually see a technical support from this 200-week moving average before we move into a new intermediate cycle. Next, looking at gold, all throughout March, I did mention in a couple of my videos that I was expecting the intermediate cycle in gold to top, gold dropping down into the daily cycle low. There will be a bit of a bounce into perhaps one more daily cycle low before gold drops down into that intermediate cycle low. The last time I shared my views on gold was in the middle of March. So far gold has behaved as we have expected. It seems to have topped for this ongoing intermediate cycle. Perhaps a bit of a bounce from this 50-day moving average before the decline down into the intermediate cycle low, which again is often a nice buying opportunity. Moving on to crude oil, cycles usually last for around 160-159 days on average since the middle of 2017. All through February, I mentioned that I was expecting the crude oil cycle low over the next couple of weeks. We did see a bit of a bounce during March. Personally, I did think that crude oil was ready to go into a new intermediate cycle. I didn't expect this significant drop, but of course everything is dropping right now. Extending this cycle duration though, we're already 211 days long. It's quite unusual, but we have seen a cycle as long as 233 days within this period since the middle of 2017. So looking at a couple of possibilities on crude oil, one of those possibilities is that crude oil has actually created the cycle low over here in early March, and a new cycle has started. It has already broken down, meaning that crude oil is going to be relatively weak for the remainder of the cycle for another couple of months. I wouldn't think that this is a most likely outcome. I would give this, say, perhaps 30% chance. While a more likely outcome, in my opinion, say 70% chance, is that crude oil is about to finally give us that cycle low, which I was expecting in mid-March, followed by a bit of a recovery, perhaps not a significant recovery, because if the stock market isn't doing particularly well, crude oil isn't going to be that strong either. Staying on the topic of energy, let's have a look at uranium. This is a URA ETF. We haven't actually looked at uranium for quite a while. There was a mild decline down into this cycle low into the middle of January. At the time, I wasn't actually sure if that would turn out to be that cycle low, as the bounce into the new cycle only turned out to be relatively short-lived. Uranium, as well as crude oil, has declined for most of 2025. But coming back to this decline, while it was relatively mild, has ticked all of the boxes, has signed all of the signs. We see multiple pokes below relatively wide Bollinger Bands. We see a significant drop in RSI, drop into oversold territory. So a following bounce that would sustain the price above 50-day moving average for at least a few days would also signal the start of a new cycle. So drawing a cycle from mid-2024 into late December, mid-January this year would imply that we are now in a new cycle that has so far been going on for only 98 days. The usual duration for uranium cycles is about 160 days. That's at least back from the pandemic low. So we are probably a bit too early for the cycle low to form on the 7th of April. In the next few weeks though, as S&P perhaps forms a positive divergence, so might URA, continuing this cycle a bit closer into that average duration before moving higher into the next cycle, perhaps in another several weeks. In the very long term though, over the next 2 to 3 to 4 years, I am extremely bullish on uranium. In fact, back at myfinanceteacher.org, we regularly produce the best uranium report on the internet. Make sure to join us, check out the uranium report, which I post nearly monthly. There's a wealth of fundamental as well as technical information. For now, we continue though, again staying with the topic of energy, looking at natural gas. I haven't looked at natural gas cycles for quite a while, and last time, unfortunately, I was selling my natural gas positions a little bit too early before this pump up into nearly $5. Now, though, it is clear that natural gas, as well as many other assets, is declining down into the cycle low. We see a poke through the Bollinger Bands. The Bollinger Bands aren't extremely wide yet, so I expect a repeated poke against widening Bollinger Bands. In terms of cycle duration, we are now already 126 days into this ongoing cycle. On average, the cycles last for 122 days since the middle of 2017. And yes, they might extend into as long as a half a year cycle. So we'll have to stay patient here for another few weeks. But I do expect a cycle low in natural gas, again, within that few weeks. And in the very, very long term, I am, again, bullish on natural gas on the US side as the exporting liquefaction facilities are coming online and expanding over the next couple of years, sending that liquefied natural gas to places with higher prices such as European markets. And again, for more information on cash cows, that's basically relatively inexpensive producers with very healthy cash flows, make sure to join us at myfinanceteacher.org. For now though, we're going to continue into commodities, looking at copper. Again, the last time we looked at copper was at the beginning of February, where we were expecting copper to move higher into this new copper cycle. Since then and into the cycle top, copper has gained around 22% or so, but of course, recently, over the last couple of weeks, together with most assets, it has dropped significantly as well, down into this cycle low, which most likely hasn't happened yet. Again, I do expect weakness in the stock market to persist for another few weeks. Plus, the average duration of these copper cycles is 137 days. So similar to the general stock market, copper might actually find a bit of a resistance at 200-day moving average and form a bit of a positive divergence over the next few weeks with a bit of a lower low versus the higher low on RSI. Again, in the very short term though, I do expect a bit of a bounce as we are quite oversold, with price poking significantly below very wide Bollinger Bands. So that is copper. And lastly, let's have a look at Bitcoin. Bitcoin is now 29 days into its cycle. The usual duration is about a couple of months, going for years and years, even far back beyond the pandemic lows. So until we reach a little bit closer to that average duration of a couple of months, I wouldn't expect Bitcoin to be particularly strong. Perhaps a bit of a resistance again from that 50-day moving average before a decline down into that cycle low. So there's an outlook for you for 7 assets. Do you agree or disagree with my expectations? Of course, nobody does know the future. And let me know which of these 7 do you find to be most promising, let's say over the next couple of months. Have a wonderful Wednesday. Bye bye.